In Toronto, here is Nick. Go ahead, sir.
Hello, gentlemen. Thank you for taking my call.
Sure.
Open text. Lately, the stock goes sideways. Is there any underlying reasons for the stock to behave that way?
Right.
And if it's a sell, if it's a buy or a hold? Thank you.
Great. So, Nick, let me take it from the way we look at the world. First of all, software. Software has been a great sector to be focused on over the last 6 or 7 months. It's a sector that benefits as companies increase their capital spending. Open text, of course, and document management. The stock, if you went back a couple of months, had a day where it broke from 45 and traded to $52 and left a big gap in the chart. Now, in the last 3-4 weeks, as I mentioned, a lot of the higher multiple stocks pulled back a little coming into the end of the quarter, people taking profits, which is my take on it. A lot of them pulled back into the moving averages. It just so happens that OpenText has pulled back and virtually closed that gap that it left on the chart. Now, that happens all the time, and technically there's a whole bunch of reasons we could talk about as to why that happens. I think it's actually a pretty good entry point here. I would use $44, $45 US as a stop. If it broke those lows, I think it'd be a reason to come out. I like the group. I like the stock. They've got good revenue growth and earnings growth going forward. I think it gives you a good entry point here.
Are you in this for clients?
We are not in this stock, but certainly I've looked at it.
But you can't own everything, right?
No.
Musad in London, Ontario is next. Go ahead, sir.
Yes, good evening. Thanks for taking my call. Yeah, Mr. Burrows, I really appreciate your opinion. I found it very informative. I would like to ask you about, specifically about Suncor and CNQ. I'm invested heavily in these two companies. And since you know oil stocks are cyclical, what do you think? Is there more upside for them, or it's a good time to get some profit?
Okay.
Since I'm really having more than my 50% of my portfolio in these two equities. I really appreciate your opinion. Thank you very much.
Okay, maybe a comment on that first off.
So first of all, 50% is a lot.
Yeah.
That clearly is a very concentrated portfolio, especially if it's just in the two names.
Mm-hmm.
I will say that energy for us has come up considerably over the last month in our portfolios. We've been more focused on the mid-sized, more quickly growing producers, those that are using technology to add to reserves and production rapidly. But I will say CNQ is a position that we've built over the last 2 months and is performing really, really well.
Yeah.
I happen to like Canadian Natural Resources of the two. I think that, first of all, they got a great balance sheet, and they will have an opportunity to grow nicely going forward. They've just made a couple of very nice acquisition. We think that we're going to get accelerated dividend growth going forward as some of the new operations ramp up, and the stock is behaving extremely well. In general, we like the mid-cap producers better, but CNQ is one of our larger holdings, and this is the one that I would be focused in.
And do you have a mid-cap name for us that's not a top pick?
Well, Diamondback Energy is one we've talked about over the last year. We like companies that are in the Eagle Ford and the Pembina that are getting rapid growth. We like Torque Resources. We like Baytex. Mm-hmm. We like Whiting Petroleum.
Okay.
Like Pioneer. There's quite a number in the U.S. The interesting thing, the most interesting thing about these companies is that the cost to drill and bring a well on has fallen at a compound annual rate of 12% a year for the last 3 years. So the cost to bring stuff into production is going down, and that is likely to continue for the next 4 or 5 years. So the cost to go out and find and bring on production is very low, and not only that, but the time from beginning of drilling to bring it onto production is getting much quicker. So there are companies out there that have time from the beginning of drilling to production of 8 and 12 days. So they're building these big pads and doing multiple drill holes. And so they're just getting better. So this is technology at play.
And here's one of the ones you mentioned.
Right. And there are all kinds of companies, Concho Resources, Range Resources, that are really taking advantage of this technology. So this is a secular play, a long-term play, and it's one I think you need to be invested in.
New era. Dave is in Toronto as we stick with energy. Go ahead, Dave.
Gentlemen. Yes, a person this morning was talking about Penn Growth, and he managed to tell us that Penn Growth in about 7 months will be spewing oil, and the stock, we could expect the stock price to double because of the Hindenburg oil. Is that your spin on this, or do you know about it, David?
Dave, that's a fair question. I have to be honest, I haven't spent a lot of time looking at pen growth over the last little while. In the yield-oriented energy equities, we've focused in white cap energy and tourmaline, and we have not spent a lot of time looking at pen growth, so I could get back to you on that.
All right, fair enough. Jason is in Nobleton, Ontario, in a different kind of energy here. Go ahead, Jason.
Thank you. I'd like to ask on Encana. I'd like to ask if his opinion on the 12-month projection. Thank you.
Okay. So certainly Encana, like many of the other energy producers, is performing much better. Again, if I were looking at a large cap, I'd look at a CNQ. If I'm looking at mid caps, I'm looking at the more quickly growing names. You're going to get sector perform, I think, out of Encana, and I'd prefer to look at other names.
Such as tourmaline.
Yeah.
Right. There's Encana, good run lately. Let's take a break, and we'll get back to questions right after this break.